Welcome back. In this video, I'm going to give you some understanding about algorithmic trading. Algorithmic trading uses mathematics and computer programming to reduce the effect of human emotions and biases in trading. Algorithmic trading is often used for two purposes. The first is to automate order executions for efficiently executing large orders. The second is to place automated trades in order to profit from them. Often the term algorithmic trading is used to refer to automating the order execution, while the term automated trading is used to refer to place trades in order to profit. Automated trading involves automation of the complete trading process. When a new investor asks this question, he often has automated trading in mind, where he wants to profit from using a programmed trading strategy to execute his trades. In order to be effective at automated or algorithmic trading, one needs skills in two domains. First is computer programming, and the other is some amount of knowledge of mathematics or statistics. These skills may or may not be readily present in every individual. Brokers often assist high net worth individuals to execute trades using algorithmic trading, but the same is not true for automated trading. Automated trading requires developing a trading system that applies certain rules to determine the entry price for the trade and also to determine the exit. Before deploying any trading system in the market, one needs to backtest this system using historical data to determine if the trading system has been profitable in the past. This essentially means that the trader may need to create and test multiple trading systems before he comes across a profitable trading system. Even after finding and fine-tuning such a trading system, it is not uncommon to find a system that works well in simulated setting, but it does not work so well when implemented on real-time markets. What is more, even if a trading system works, one needs to continuously monitor these systems when they are operating in the market, as they require manual abort if something goes wrong. As there are multiple tasks that need to be performed in order to be successful in automated trading, it is often best to work in teams instead of individually. Also, automated traders need to adhere to strict guidelines from various exchanges in terms of capital requirement and system requirements, which may be capital intensive in nature. It is not uncommon for stiff penalties to be levied by the exchanges if automated trading firms are found in violation of their rules. Hence, considering the complexities involved in automated trading, it is best for new investors to not immediately indulge in automated trading in individual capacity. In fact, a team setting is probably the best place for any beginner to start with automated trading. So if you are really serious about getting into automated trading, you should do it in teams. In this video, I have shared my thoughts on how individuals should approach algorithmic trading. Depending on your skill sets and your mindset, you should take a call on how you want to proceed in this area. For now, I'm going to move on to the next topic, which is money management for retail investors. So see you in the next video.